Today's lecture will be on Chapter 27, Partnerships. We're going to be looking at the Revised Uniform Partnership Act, or RUPA, for many provisions of today's lecture. Under RUPA, a partnership is an association of two or more persons to carry on as co-owners of a business for profit. So you can see the elements needed to create a partnership. It has to be at least two people. The business has to be profit. Nonprofits are not partnerships, and you're co-owners, which means they must equally own the business, that they equally share the profits, and they equally share the losses, because as you remember, the general rule about partnerships is that unless anything is stated, each partnership is a general partnership. In a general partnership, you have one partner. They're known as general partners. They each assume all the liability. They have unlimited personal liability, and they each both will split in the profits. So when you create a partnership, unless you state otherwise, it's a general partnership. For most of today's lecture, we'll be talking about general partnerships until the very end. So again, here's a good slide that just encapsulated what I just stated. So sometimes you don't expressly state with somebody else you want to become a partner. So when there's a dispute, whether the partnership even exists or not, we look at certain factors. First factor is were the profits, to the extent you made any, shared, or were the losses shared. So shared profits or losses are presumptive evidence of partnership. In addition, did you share in the management and duties? If you did, that's a presumptive existence that a partnership was created. So you can be liable as a partner even if you're not a partner. That's known as a purported partnership. So for example, if you go to a bank with a friend and tell the banker that you're a partner, the banker can hold you liable as a partner even though you're not. Now please listen to what I'm going to say with regards to articles of partnership. They are not required, but are desirable. In fact, you should always have this. So an articles of partnership is another name for a partnership agreement. You should always have articles of partnership or a partnership agreement that discusses what happens with regards to the death of a partner, how profits should be split, because oftentimes one partner does more of the work and thus he or she should receive more of the profits, and how a partner may exit the partnership. In the absence of a partnership agreement, you have a general partnership and profits are lost, losses are split evenly. Finally, a joint venture may be distinct from a partnership. A joint venture relates to a partnership but for a single enterprise or transaction. So even though it's a joint venture, partnership law will apply to it, but the difference is that with a joint venture, the authority of a partner in a joint venture may be limited to his or her implicit or apparent authority. Speaking of authority, remember, we're talking about general partnership with only one type of partner, general partners. So each general partner normally has an equal voice. Usually majority rules when you have a dispute. So if you have three general partners, if it goes 2-for-1, the majority rules. However, you do need to have unanimous agreement when it's related to a decision that's outside of the ordinary course of the partnership or contrary to an agreement that you created. How can you have authority? Well, it's very much the same way when we talked about agency law. You can have actual express authority based on either the partnership agreement or actual implied authority, or you could have apparent authority. Remember, apparent authority is the test was justifiable belief in the mind of the outside third party. In addition, partners may become liable if they ratify previously unauthorized actions. The bottom line with partnership property is that partnership property belongs to the partnership if title or possession was transferred from the individual partner to the partnership. Partners however, have a partnership interest in partnership property. They can use it for business use, but they can't use it for personal use. In addition, an individual creditor of an individual partner may not go after partnership property. However, based on the notion of what's known as a charging order, the individual creditor of an individual partner, if he or she gets a judgment against that partner, they can force the court to order the partner's interest in the partnership be sold to satisfy the claim. What are rights and duties of general partners in a general partnership? Well, again, the rule is that you split profits and losses. So a partner is not ordinarily entitled to a salary or a wage. Compensation is their share of profits. And with a general partnership, all profits are split equally unless the partnership agreement says otherwise. Notice that the duties that we have here, such as good faith and loyalty, and the others mirror the same duties that an agent owes to his or her principal. Under the revised Uniform Partnership Act, let's look at rights and liabilities from three aspects: contracts, torts, and crimes. First, with regards to contracts, the partnership is primarily liable for contracts it makes. However, if the partnership doesn't pay, each of the individual partners are jointly and severally liable. Because remember, general partners have unlimited personal liability. With regards to torts, we need to look at what happens when an individual partner, general partner, creates a tort or a civil wrong. Well, under the doctrine of respondeat superior, or let the master answer, the general partnership is liable for torts committed while doing business, so long as it's within the scope of employment. If the partnership can't pay, then again, individual partners will be jointly and severally liable because they have unlimited personal liability, even though they did not personally commit the tort. So be careful who you go into partnership with. Finally, with regards to crimes, the general partnership may be liable for crimes and may have to pay fines. However, you can imprison a partnership. In addition, the partner's individual will not be imprisoned for a crime committed by one partner, by another partner, even if it was done in the name of the business. Let me give you some key terms here, but the four key terms I need to give you are disassociation, dissolution, winding up, and termination. First, disassociation. A disassociation is any change in the relationship among the partners. Second, dissolution. A dissolution is the beginning of the process of settling all of the partnership affairs. Third, winding up. Winding up is the orderly liquidation of the partnership's assets. Finally, number 4, termination. Termination is the end of the partnership's existence. So you have to know these 4 key terms. Please change the title of this slide and get rid of the word death and change it to the word end of the partnership. So the end of the partnership can happen. Partners want out. Let's first talk about how a partner will disassociate himself or herself versus the dissolution of the partnership. So let's first talk about disassociation of an individual partner. There are 2 types of disassociation: a rightful disassociation or a wrongful disassociation. It'll either be rightfully done or wrongfully done. Here is the general rule regarding disassociation. A partner has the power to disassociate from the partnership at any time by expressing an interest to withdraw. However, a partner does not always have the right to disassociate. So the general rule is that any partner has the power to disassociate, but they may or may not have the right to dissociate. So any disassociation will either be rightful or wrongful. A rightful disassociation can be done in two ways. One, a term partnership, and two, a partnership at will. The first type of rightful disassociation is known as a term partnership. Under a term partnership, the disassociation will be rightful if either the expiration of the term of the agreement or the completion of the undertaking. So for the term of the agreement, if you said here that we are going to be partners for 5 years, after 5 years, the time period has expired. Or under the completion of an undertaking, if the partnership agreement was to build a hospital, once you built the hospital, the undertaking has been completed. The second type of rightful disassociation is known as a partnership at will. Under a partnership at will, any partner may disassociate at any time prior, so long as they provide notice to the other parties. So when you do not state the terms, either in terms of the time period or the completion of the undertaking, then you can leave at any time. So, for instance, if two people decide to be partners and they don't put either a time period or a completion of undertaking, then the partner can leave at any time, and that's a rightful dissociation at his or her own will. A couple other things to note with rightful disassociation. The partners can always unanimously agree to dissolve the partnership. In addition, the partners can expel another partner if that wrongful partner violated the partnership agreement. If the disassociation isn't rightful, then it is wrongful. A wrongful disassociation is a disassociation that is not rightful. So if it's not right, it's wrong. If there's a wrongful disassociation, then the partner who wrongfully disassociates may not demand the dissolution of the partnership and help in the winding up of the partnership. And may not participate in winding up. Take a look at this slide. It will definitely help you out in your study guides. Again, please switch the title of this slide to dissolution and winding up, not disassociation and winding up, but dissolution and winding up. So now this is where dissolution, if you remember, was the beginning of the process of settling all the partnership's affairs when you decide you no longer want to be a partnership. So remember, a partner who wrongfully disassociates loses the right to demand dissolution of the partnership and help in the winding up. What is winding up? Winding up involves selling or liquidating the assets at the highest value when you're dissolving the partnership. It's important to be part of winding up because you do get paid for winding up, and you want to make sure that when you're selling or liquidating assets, you get the highest price for it. Please note here, sometimes a partner wants to disassociate himself or herself from the partnership, but the other partners want to remain. If it's a term partnership, which is, remember, for either a time period or the completion of an undertaking, unless you have unanimous agreement to continue by all partners, then the partnership will dissolve. If it's a partnership at will, When one of the parties decides to disassociate, the remaining partners have no right to continue the business unless there's an agreement within the partnership agreement. That's why it's so important to have an articles of partnership. In addition, courts generally enforce partnership agreements that provide for a continuation of partnership, and sometimes there are buyouts that are allowed. So let's talk about liabilities that individual partners will have for obligations based on the partnership. Let's first talk about liability for prior or past obligations. The continuing partnership will obviously be liable for debts incurred by the original partnership. A disassociating partner will remain liable for any past debts if the continuing partnership can or will not pay for it. The old partner also oftentimes may try to seek a novation from the continuing partnership and the creditor to discharge the old partner from the prior debt. New partners will generally not be liable for any old prior obligations, which is called antecedent debts. Now let's look at liabilities for new obligations. So it's very important that when a partner disassociates himself or herself from the partnership, that he or she give notice of his or her withdrawal. Because unless they give notice, the partner that disassociates will be responsible for the new obligations of the continuing partnership. So you should always give notice to outside third parties that you are disassociating yourself from the partnership. That notice may either be actual or constructive. So now we're dissolving the partnership and winding up. How are the assets distributed? Well, first, you got to pay the people who you owe first. So the partnership creditors get paid first. Outside creditors get paid first, and then partnership creditors or partners that loaned money to the partnership get paid second. So in terms of you paying creditors, it's always outside creditors first and inside creditors afterwards. Second, if there's any profits after paying the people that you owe, you distribute to the partners pro rata based on the amounts of their capital accounts. And capital accounts is the amount that they contributed to the partnership. So if one partner contributed more in terms of money and property, they should get more money back when it winds up. Now let's say there's not enough money after paying your people that you owe and paying your capital accounts, then each partner may be jointly and severally liable because there's a limited personal liability. Once you have finished winding up, that's when you have termination. So assets then have been entirely distributed and the partnership's creditors are satisfied. Now the partnership can finally be terminated. Up till now, we've talked about general partnerships from slide 1 all the way up till this slide. Now I want to talk in the last few slides about 3 other types of partnerships. Remember, the default type of partnership was a general partnership. A second type of partnership is known as a limited partnership. Remember, limited partnerships have at least one general partner and at least one limited partner. The general partner has unlimited personal liability, while the limited partners are not responsible for partnership debts, and their liability is limited to the amount that they contributed to the partnership. Unlike a general partnership, a limited partnership must file certificates with the Secretary of State in order to form a limited partnership, because you are telling, in essence, anyone doing business with this partnership that it's a limited partnership and there are certain partners who have limited liability. You do not have to file with the certificates with the Secretary of State for a general partnership. Limited partners in a limited partnership are not fiduciaries, whereas general partners are. However, it's important that the limited partnership complete the formalities and file correctly, because if you don't file correctly with the Secretary of State, then it's no longer a limited partnership and now it's a general partnership. And thus, as you know, with a general partnership, each partner has unlimited personal liability. Limited partners have limited control, so they can't take control of the business. That is the role of the general partner. And just like with general partnerships, limited partnerships may also be dissolved and go through the wind-up process to be eventually terminated. Finally, I want to talk about limited liability partnerships, or LLPs, and limited liability limited partnerships, or LLLPs. First, limited liability partnerships. A limited liability partnership is a type of general partnership that grants limited liability to all the general partners. So why would you ever form a general partnership today when you can form an LLP? It's still a general partnership, but now all the general partners have limited liability. Second, a limited liability limited partnership. This is a type of limited partnership that grants limited liability to the general partners as well. We know that in a limited partnership, there's both at least one general partner and at least one limited partner. Well, with a limited liability limited partnership, it allows the general partner still to have management and control, but also gives that person limited liability. This concludes our lecture on Chapter 27, Partnerships.